In this lesson, we're going to talk about accounting for long-term liabilities. And I think at this point, we surely know what a liability is. We learned about current liabilities in Chapter 9. Liabilities are those things that we owe. It's someone else's claim on our resources. Well, Chapter 9 was about accounting for current liabilities, and this time we're going to talk about accounting for long-term liabilities. And if you think about classifications, current means anything in 1 year or less, and long-term means anything more than 1 year. So we're talking about the debts that we owe that are going to span longer than 1 year. So the bulk of what we're going to learn here in Chapter 10 is going to be about bond financing. And it's interesting because when most people think about buying bonds, they think about making an investment. Well, and that's true. You are making an investment because you are using your money to return something that's going to grow or make you more money. As an investor, when you buy a bond, you give up your money and then someone pays you interest. And then at the end of it, you get your money back. So why are we talking about this in a long-term liabilities lesson and not a lesson on assets or investments? Well, we're not the investor. We're the corporation who is issuing the bonds out to investors. And when you think about what happens for us, the corporation, when we're talking about bonds, we are getting money from someone, we're using that money, and for its use, we are paying that person interest. And at the end of its life, the bond's life, we have to pay the money back. Well, that sounds a lot like a loan, doesn't it? It sounds exactly like we've borrowed money. And that's exactly what we've done. So the corporation will issue a bond and pay interest payments to its investors. From the bond issue date, it sends bond interest payments out to its investors on a periodic basis, on a very regular interval at that. How do we figure out the interest payment that gets paid out to investors? Well, we simply take the bond's par value, and that's the stated face value of the bond, multiplied by the stated interest rate on the bond. The bond tells us what the par value is and tells us what its interest rate is, and then we multiply that by time. Well, that's just the standard formula for interest, right? So what are the advantages of borrowing money by bond financing? Well, first off, when we issue bonds out to investors, it doesn't affect our owner control because those investors, quote unquote, if I'm doing air quotes here, what you can't see me, those investors have no ownership in the company. They've just loaned us money. Certainly the interest that we pay on the bonds is tax deductible. We get a tax deduction for that. And I would say that that's 6 of one and half a dozen of another because you're still paying interest. You're paying money out, right? Bonds can increase our return on equity because now we're able to use leveraged funds in order to expand our business, and that gives us a higher return on equity. But interestingly enough, if you look directly across, it says bonds can decrease return on equity, and it's because you can actually end up spending too much of those funds out and rolling your equity in an upside down kind of motion. Of course, another disadvantage is that bonds require payment of both periodic interest and par value at maturity, meaning that unlike stock investments, we have to pay back the entire face value of the bond at the end. You've got to be able to do some cash management to make sure you have that money available. So when bonds are traded or bonds are sold, really is the way to say that, they're traded usually at a percentage of par value. So if you had a bond that had a par value of $100,000 and it sells at 121.18% of par value, what's it going to sell for? Simple math tells us that that $100,000 bond is going to sell for $121,180. So here you'll see a bond certificate. Truth of the matter is we don't see many of these anymore. Bonds live in the digital world just like stock certificates do. I will tell you that if you find a bond, or if you even find a stock certificate, you should try to hang on to it, make whatever digital trade you have, and try to, just frame the bond, hang it on the wall, because they're becoming highly sought after as framed articles or framed antiques. This would certainly be one, but let's talk about a couple of these things. Here is that par or stated value of the bond that says this bond's value is $10,000. Because this is on the face of the bond, it means that at the end of this bond's life, $10,000 has to be paid back to the bearer of the bond or whoever it is registered to. So no matter what, and this is a legal document, by the way, this $10,000 has to be paid back to someone. Well, do you have to pay any interest? Sure. Here's the stated interest rate. It's 8.875%. So no matter what, the person who holds this bond gets paid 8.875% of $10,000 every year until the bond becomes due. Now you'll see this one was issued in 1972, but it has a maturity date of 2000. So basically what's going to happen is that the Dow Chemical Company is going to pay, it looks like Shaw and CC, going to pay these people 8.875% of $10,000 every year from 1972 up until 2000. Okay? Legal contract. No matter what, you can't change what happens on this bond. All right, so what happens on the accounting side of things when we issue the bonds? Let's look at an example. On January 1, a company, that's us, issued the following bonds. It had a par value of $800,000 and a stated interest rate of 9%. Now look at this. It pays interest twice per year. Do you remember the rule for interest rates? They're always annual. So that stated interest rate is 9% per year. So what's going to happen on June 30th? Well, on June 30th, we're going to pay interest at 1/2 of 9% times 800,000. Basically, we're going to take 800,000 times 4.5%, and we're going to pay that on June 30th, and then 800,000 times 4.5% and pay it on 12/31. So it pays semi-annually. $800,000 bond, 9% interest, paying semi-annually, and it's a 20-year bond. So we're issuing this at par, which means we are actually borrowing the exact same number that is on the face of the bond. What are we going to get? We're the company. We're borrowing money. So we get cash and we put that in as a debit. And then we credit bonds payable as our liability. We owe a bond out at $800,000. So we owe somebody $800,000. So on June 30th, this is our first interest payment. The issuer of the bond pays the first semi-annual interest payment of $36,000. How do I calculate it? Well, I take $800,000 times 9% times 1/2 of the year. I can multiply this 0.5. I could hit equal right here and divide by 2. Doesn't matter which way you do it. It's still going to work out to $36,000. And you're going to do this twice a year until the bonds mature. It's going to be made every 6 months. So guess what the journal entry is going to look like on December 31? Right. It's going to look exactly the same. It's going to be bond interest expense $36,000 and cash $36,000. On December 31, 2034, this is 20 years in the future, we're done. We're finished. We've paid all the interest payments. 20 years have elapsed. Guess what? We got to pay that $800,000 back to the people we borrowed the money from. So we take the payable off the books at $800,000 and we pay out cash of $800,000. Do you think you have to have some good cash management processes in place to do this? Absolutely you do. Not only that, but if you calculate out what you're paying in interest every year, this is a pretty expensive bond. $36,000 every 6 months is what you're paying to borrow this money. All right, so why then do bonds sell at higher than par value or lower than par value? Remember when we said it might sell at 121% of par, right? Well, here's the deal. The bond itself, the face of the bond says how much interest this bond has to pay to the person that we issued it to. However, the market, by the way, this is the bank or the Fed in the United States. The market sets what the market rate of interest is. And really kind of in a nutshell, if my bond pays more interest than what the bank pays, then I should be able to upcharge the price of my bond. Let me say it another way. Let's say that my bond contract rate is 8%, okay, which means that I'm going to pay whoever holds that bond 8% every year until it matures. But the bank is only paying 6%. Well, people want to buy my bond, right? Because otherwise I could say, you can always go to the bank and make 6%, They're like, well, what do you mean? I want to buy your bond. Yeah, but now it's going to cost you a little bit more because you're going to make more money off of mine than you will if you go to the government agency, basically, that regulates interest rates, right? So you get to upcharge the bond. And we call that a premium, by the way. Just the opposite happens if the contract rate, our bond, is lower than the market. Now you've got an investor who looks at our bond, and let's say our bond is paying 8%, but maybe the bank rate is 10. That'll be a whole different economy than what we're in right now, by the way. So if the bank pays 10%, but our bond only pays 8, and an investor says, gosh, I've got this $100,000 to invest, and we're saying, hey, come over here, invest it with us. Look, we're paying 8%. And they're like, yeah, why should I bring my money to you? I can just go put it in the bank and make 10. And you're like, okay, look, I really need to borrow the money, so I'll sell you this bond on the cheap. I'll give you a discount. You don't have to pay me $100,000 for it. Pay me $96,000 for it, or something like that. So you give them some incentive to buy your bond by offering them a discount. So when the contract rate, that's our bond rate, is less than what the bank rate or market rate is, then we sell our bond at a discount. We sell it for less. And of course, that creates some accounting problems for us. So let's look at issuing bonds at a discount. Here's going to be the example. It's Phyla, and she issues bonds with it issues bonds with the following provisions. The par value is $100,000, but the issue price is 96.454%. How much cash are we going to get? Yeah, 96.45% of $100,000. We're going to get $96,454. Why are we selling it lower? Because our bond is selling at 8% and the bank will give you 10%, right? So they can go to the bank and make more money. So we need to give them some incentive to buy our bonds. Phyla pays interest semi-annually. It pays it on June 30th and 12/31. The bond date is currently 12/31/15 and it matures in 2 years at the end of 2017. So on December 31st, how would we in accounting for Phyla record the bond? Well, we know we're going to get cash of $96,454. You know me, I like to do what I know. We book the cash in at $96,454 because that's what we issued it at. We book the bonds payable at $100,000. Why don't we do this at $96,454? Because the bond is a legal document that says we must pay $100,000 back at the end of 2 years. I owe $100 to someone. So I book in the cash, I book in the bonds payable, and I need a difference, right? I've got to plug a number in here. It's $3,546. Well, because this is operating at a discount, I'm going to create a new account called Discount on Bonds Payable. And that's going to be a contra liability account. And you know what that does, right? We've talked about these before. A contra account is going to negate something else. So what's going to happen is our balance sheet's going to show a liability for bonds payable of $100,000 less the discount on bonds payable for $3,546. All right, here's just another way to kind of look at it, but here's how we see it on the balance sheet. Remember that bonds payable 100 less the discount on bonds payable. This is the maturity value. This is what we're going to pay back, but currently on the balance sheet it has a lower value to us. It's what we call the carrying value. Well, here's the problem, folks. At the end of 2 years, I've got to pay back $100,000. I can't have this $96,000 just sitting on the books there, right? If I've got to pay $100,000 back, I've got to take $100,000 off. What am I ever going to do with this $3,546? Well, there's another way to think about this. If I look at the fact that this bond has to make 4 interest payments of $4,000, right? $100,000, 8%, half year each, right? That's 4 payments of $4,000. That means that over the life of this bond, I've got to pay $16,000 in interest in order to borrow this money. But I've got to pay back $100,000 when I only got $96,454. That means that I've kind of already paid the bondholder $3,546. I've kind of already given them this money. It's almost as if they would have given me a check for $100,000 and I immediately gave them $3,546 back. Well, that $3,546 discount really is just interest, right? I'm kind of giving them a bonus back on their interest. So truly, the amount of interest that this bond is costing me over its life is not $16,000, it's $19,546. And because of that, what we're really going to see every interest period is interest expense being recorded at $4,887. Well, that creates another problem because I'm only going to be paying $4,000. Why don't I just pay out $4,000? Why don't I just put it on the books at $96,454 and pay out $4,887? Sorry, not that easy. It's just not the way it works. The bond says I have to pay equal periodic payments of $4,000 because it's a legal contract, right? So here's what happens on a bond with a discount when I have to pay the interest back. What are the things I know? I know that I've got to pay cash out of $4,000. But how am I going to book that interest expense? Well, I just do a straight line amortization of the discount. There's the discount divided by 4 periods. There's the $887. So I'm going to book bond interest expense of $4,887, and then I'm going to reduce that discount account. Do you remember how that $3,546 went on the books? It went on as a debit. So now we're taking out $887 4 times. Guess what the discount account's going to have in it at the end of 2 years? It's going to have nothing in it, right? And I'm just going to have $100,000 on the books as a carrying value. Here's just another way to view it. At 12/31/15, when I issued the bonds, I had an unamortized discount of $3,546, leaving me a carrying value. But if I amortize this out over 4 periods, looks like I had to do a little bit of rounding here at the bottom. If I make the payment of $4,000 but book the interest at $48.87 and remove $887 from this $35.46, at the end of this current period, or at period 1, my carrying value jumps up a little bit. And at the end of period 2, my carrying value jumps up by another $887. Period 3, another $887, until I finally get to the end of period 4, and all I have left on my books for bond liability is the $100,000. And that's a great thing, because that's exactly what I have to pay back to the bondholder. What about issuing bonds at a premium? This is simple. It's the same thing. It's just instead of a debit, it becomes a credit. So we just kind of reverse it a little bit. In this, we're looking at Adidas. It's a par value $100,000, issuing at $103.546. That means we're going to sell it for $103,546. Why do we get to sell it at a premium? Because our rate is higher than the banks. They want to come and give us their $100,000, and we're like, wait a minute, you can just take your money to the bank. My bond's paying more than the bank, so I'm going to go ahead and make a little bit more money on it. I'm going to charge you a premium. The interest dates are 6/30 and 12/31 again, and still a 2-year bond. The same kind of thing happens. What do I know? I know that I get cash of $103,546. I know that I owe $100,000 at the end. I've got to have a $3,546 credit. And when that happens, it's going to be a premium on bonds payable. This one's not a contra account because a contra account negates some other account, but an adjunct account adds to it. So here's what it looks like. This is what we show it as on the balance sheet. Now the carrying value is higher, but we have to get that carry value back down to $100,000, right? Yep, you're right. Guess what we have to do? We have to amortize that premium now off the books. What does it mean? It means that our interest expense every period is going to be lower instead of higher, right? So here's the entry every 6 months. What do I have to pay? I have to pay $6,000, and I also have to get one portion of that premium off the books. A quarter of the premium has to come off the books, meaning that my interest expense is going to be just a little bit lower. Here's what it looks like in the table. We're going from a carry value of $103,546 down to $100,000. It's the same thing. We're just working it out backwards. All right. How do we figure out that price? How do we get to $96,454? Do we just pull the number out of the air and say, you know what, because my stated rate sucks and you can go to the bank, then you should just give me $96,454 and it should be good, right? Yeah, that's not how it works. We actually have a very scientific method of figuring out what a bond should sell for. Truth of the matter is, when you sell a bond at a discount or sell a bond at a premium, then the investor is buying this bond from you and they're actually making the same amount of interest as if they had taken their money to the bank and gotten the market rate of interest. So, and then you might say, well, why don't they just go to the bank then anyway? Well, maybe they believe in what you're doing. Maybe they would rather do bond financing than dealing with the bank. There's a lot of different reasons that people would buy bonds rather than going to the bank to do it. But at the end of the day, they are really buying the bonds at the same rate of interest income to them as if they were doing it at the bank. All right. So the way that we do bond pricing is that we have to consider the time value of money. I don't know if you've ever heard this old saying before, but $1 in your pocket today is worth more now than it will be a year from now. And why is that? Well, if I leave that dollar in my pocket and I don't do anything with it, then I will have lost interest on that dollar. I could have put it in the bank and made $1. So the time value of money tries to explain what happens to $1 if you don't have it to use or invest it, right? Well, if I loan my money to someone, right? If I loan $100,000 to someone, I don't have it in my pocket to do something with it. So what's the present value of it if I do nothing with it? And that's where we look at the present value of the cash outflow for the lump sum at the end of the bond life. But I end up getting some of the interest. I start to get some of that money back periodically. So I have to look at the two cash flows that are related to this bond in order to figure out how to price it. And then I have to figure out the present value of the bond in order to show that price. And we have kind of an interesting way of doing that. We have these things called present value tables. There is a formula to figure out the present value of a lump sum and a formula to figure out the present value of an annuity. Annuities are just periodic payments. That's what interest is. And that formula takes into account the number of periods, the market rate of interest, all those great things. But accountants don't like using formulas. We like using tables. So we'll just take a look at how that works. So FILA issues bonds with the following provisions. The price is $100,000, but we don't know what we should sell it for. However, we do know that it's going to be at a discount. We know it's going to be for less than $100,000 because our rate is less than the bank. Semi-annual, 2 years. So what happens? In order to calculate that present value, we have to look at the two cash flows and we have to compare the periods to the market rate of interest. The market rate on this bond is 12%. That's what the bank is. And if we pay semi-annually, that semi-annual rate is 5%. Why do we do semi-annual? Because it pays interest over 4 periods. So you'll see, and these are in your book, these tables. I'm going to show you one in just a minute. These tables are in your book. If we go to table B1, which is the present value of one lump sum, and that's why we do it for the $100,000 amount, we go to find the present value for one lump sum. And if we find the intersection on this table of 5% and 4 periods, we're going to find this factor, this multiplier that comes from the very formula that I talked about. And if you multiply that factor by 100,000, it says that if you do nothing with your $100,000 that's in your pocket today and you hold on to it for 2 years, it is really worth only $82,270 because you've lost money on it, right? So that's the present value of the lump sum. What about those interest payments, those periodic interest payments? Well, those are an annuity, right? Equal periodic payments of anything. We call that an annuity. Table B3 is the present value of an annuity of $1. And if we go to that table and we find the intersection of 5% and 4 periods, we're going to find a factor of 3.546. We simply multiply that factor by one of those interest payments to give us a present value of $14,184, and lo and behold, it says that we should sell this bond for $96,454 to make the buyer whole. All right, and I will show you, we're going to see another thing about those tables. I'll show you one in a second. What if I retire the FILA bonds at maturity? What happens when they're all done? It doesn't matter. If it was a discount or a premium, those have been amortized off the books. It's fully amortized. I simply have to pay back the $100,000 in cash and remove the bond payable. What if I retire the bonds before maturity? That would be a callable bond. That's a certain feature that a bond can have. So let's assume that the $100,000 worth of callable bonds are going to be retired on July 1 after we paid one interest payment. And that means that our carrying value is still at $104,500 because we sold them at a premium. And it says that the bonds have a call premium of $3,000. Don't get that mixed up. A call premium is really just a penalty. It's a penalty for retiring it early, right? Because the people who are buying the bonds, they really intend to have it for 2 years and to make interest for 2 years. Well, now they've got to take their money and go find another investment. So if you're going to call bonds early, usually you have a penalty involved. How do we get this off the books? Well, let's do the stuff I know. I've got to get the $100,000 off the books because that's what the bond payable is. I know that I'm going to pay $103,000, the bond value plus the penalty of $3,000. So, okay, I've already got a problem, but I also know that I have that premium still sitting on the books. Remember, it had a carry value of $104,500. I've got to get that premium off the books now as well, and it leaves me with a problem, a $1,500 problem that I need on the credit side. Like any other sale, if it's a credit, it's a gain. If it's a debit, it's a loss. Okay, can I convert bonds to stock? Absolutely. A lot of times people will buy bonds instead of stock because they feel like the stock is just too new or maybe too risky. So they buy bonds because bonds get preferred payment in a liquidation. They get paid before any of the stockholders do. So they buy bonds instead. But sometimes those bonds can have a feature which just makes it a convertible bond. So here's the example. January 1, 100,000 par value bonds of Converse, carry value of 100,000 converted to common stock. Don't worry about what these two things are doing here yet. We're going to learn all about this in chapter 11. But really, we've got to take the bonds off the book and put them back on the books as common stock. And chapter 11 is going to tell us about how that works. Okay, that's it on bond financing. Gosh, that was enough, right? You're probably going to want to pause the video and go take a nap or something because that was kind of exhausting. But there are still other ways to borrow money for our business. And certainly one of the simplest ways, well, maybe one of the simplest ways, depending on your credit, is just go to the bank and borrow money, right? I can just go borrow money from them. We call it a notes payable. We get cash. We now owe a note back to the bank. And then we have to ask ourselves a question. When do we pay back the principal and interest? Are we going to pay it back a little bit at a time, like month to month? Are we going to pay it back once per year? Or are we going to pay it all back at the end? So certainly there can be the one that happens at the very end. We hold it until maturity and we pay the entire principal plus interest. Or maybe we make regular payments of principal plus interest. If we do this monthly, maybe we do this annually, it might be quarterly. Anybody who has a mortgage on their house understands this type of payment system because every month you pay principal plus interest on your mortgage. Same thing with an automobile loan. You pay it all back, right? So here's an example here. Fog Hog borrows $60,000 from a bank to purchase equipment. Signs an 8% installment note that requires 6 annual payments of principal plus interest. What do we get? We're Fog Hog. We get $60,000 from the bank, and we now owe the bank $60,000. That's a pretty easy entry as it would be. The really kind of magical, weird part is how do we figure out what the equal payment is supposed to be on a loan? If you've ever sat across the table from the financer or the banker and they say, okay, well, here's your loan, it's $60,000 and it's 8% interest and your payment's going to be $12,979. And you start doing the math and you're like, gosh, it doesn't seem like it works very well. Well, it doesn't work because it's all about compounding. Well, the present value tables really consider compounding. What happens if we're going to make regular periodic payments? What's it called? Do you remember? It's called an annuity. Well, if I have to make regular equal periodic payments, I should be able to go to the present value of an annuity of $1 table, that's table B3, and try to figure out my payment. I just reverse engineer the problem is all I do. If I go to table B3 and I find a factor of 4.6229 and I actually divide this face value, right, the 60,000 by that 4.6229, it's going to return to me the payment amount, the equal periodic payment. Here's what one of those present value tables looks like. This is table B3, the present value of an annuity of $1. I'm going to back up one slide. Remember, this was at 8% 6 years, 4.6229, right? So if I find 8% and I come down to 6 years, there it is, 4.6229. That's that factor. If you really like using formulas, you could do it all right here. How would I have plugged this into the formula? Well, P is that principal value. It would be 60,000 equals 1 minus 1 divided by 1 plus 0.08 to the exponent of 6, to the 6th power, right? Because that's the periods, divided by the interest rate. Who comes up with that stuff? This is why accountants don't like formulas at all. You'd have to be a mathematician to figure out how all that kind of stuff works. And because the accountants don't like formulas, we just looked at the mathematician and we said, hey, can you put that in a table for us? Because it's much, much easier to work out than trying to remember this mess, right? And all we would do is we would end up solving for our payment. All right, so installment notes with equal payments, here's what it looks like. Remember we said that that payment was $12,979? Well, we started with $60,000, right? Well, what's the interest on the $60,000? It's 8% of our $60,000, and we end up getting $4,800. That's the interest. But if we pay not $12,979 and $4,800 was interest, then $8,179 must be the principal, right? Because if $4,800 of this was interest, then $8,179 of this must be principal. So now I don't owe $60,000 anymore. I owe $60,000 minus $8,179. I have a principal balance now of $51,821. Okay, go to the next payment period. I take my $51,821 and multiply it by 8%. Now interest is only $41,46. How much principal am I paying? Well, payment minus the interest gives me my principal payment. Okay, what's my new principal balance? $51,821 minus $8,833 leaves me a balance of $42,988. And I do this every period. Look how interest is coming down, right? Why is it coming down? Because I'm always calculating it on a lower principal balance. The amount that I'm applying towards my principal, therefore, should always be going up. And it's not magic. It's not a miracle that this just happens to work. But by the time I get to my very last payment, 961, this times 8% equals 961. And when I take my payment minus 961, it happens to equal exactly what I owe on my principal balance, leaving me zero. So I will tell you that the first time that I looked at this, I was like, gosh, it seems that's crazy how that works. How did somebody figure that out? And I learned very quickly, don't try to understand how people figured it out. Just believe that the math works. All right, so if we recorded our first payment on December 31 by FogHog to the bank, you'll see what happens. I have to book the interest. I have to reduce my notes payable for my cash. The point on this slide really is that every time you make a payment on an installment note, the interest and the principal amounts are going to be applied just a little bit differently based on that amortization schedule. All right, mortgage notes and bonds. What are they? Let's just touch on that real quick. Mortgage is a legal agreement. It's a legal contract that helps protect the lender if the borrower fails to make the required payments. How does it protect the lender? Do you know? Does anybody have a mortgage? Yeah, they're going to come take your house. That's how they're protected. If you don't pay the mortgage, they get the house. So that's the protection. It gives the lender the right to be paid out of the cash proceeds from the sale of the asset. A few features of notes and bonds. We already talked about a couple of them. Convertible and callable, we've already dealt with. They're secured and unsecured notes. So it just means that you can secure it with some collateral, or maybe if you just give them a signature, it's considered unsecured. It can be registered with a name, or it can say bearer, which means if you hold the bond, it's yours. Term and serial means it's going to absolutely mature and it's over with. You'd have to go rebuy it. A serial bond is going to have a continuance clause. Okay. Present value of bonds and notes. Let's just kind of walk through this a little bit if we can, just so you'll see a little bit more about it. Here's a face amount of a bond of 100,000. Contract rate is 8, market rate is 10, paid semi-annually. Is this going to sell at a discount or a premium? Hopefully you're saying discount. Remember, the first thing that we have to do is we have to calculate the present value of that principal repayment for the number of periods paid at the market rate, right? So it's semi-annual, right? The market rate is 10. Because it's semi-annual, we're going to use 5%, right? It says that it's for 4 periods because it's a 2-year bond paying semi-annually. Look at what happens. On table B1, we find 5%, 4 periods, half the market rate because we're doing it over 4 periods, and we find that factor, 0.8227. There's 100,000 times the factor for 82,270. Do you remember the other part that we have to think about? Yeah, it's going to be that periodic interest payment. We're going to have to look at the present value of the annuity. Okay, so if we actually calculate out what our normal semi-annual interest payment would be, it's 4,000. Well, if we go to the present value of an annuity table, that's table B3, we again find 1/2 the market rate because we're paying semi-annually. So instead of 10, we look at 5, and then we look at the 4 periods, and we find that factor of 3.546, multiply it by 1 interest payment, and it gives us a present value of 14,184, and therefore we're going to issue that bond. We're going to sell it for 96,454. Finally, I want to talk just real quick about leases and pensions. Most people think that they know exactly what a lease is because it's just rent, right? I'm just going to rent something. Well, there's 2 types of leases. There's an operating lease and a capital lease. And an operating lease is rent. Basically, I'm gonna lease this machine for 5 years. I'm going to pay you the same thing every month for 5 years. And at the end of 5 years, you take it back, and maybe I can go lease another one, right? Same thing with a car lease. Those usually work that way as well. You do a car lease for 2 years, end of 2 years, you take it back, and you can go get another car and continue a lease out some other way. But a capital lease is a little bit different. In a capital lease, you're going to lease it and pay the same amount of money for 2 years, but at the end of the lease, you're going to have an option to buy it. And if your intention is to buy it, then you've got to treat that lease more as if it's a fixed asset with a note payable. So you'd actually have to find the present value of the lease in order to book the fixed asset and then book the change in present value and figure out the interest. Basically, you'd have to back into it. So an operating lease is just rent, but a capital lease, and this is all you really have to need to know about it. A capital lease is the intention to purchase, and it will be treated as a fixed asset. Defined benefit plans are the types of long-term liabilities that we deal with in employer contracts, usually just saying that we're going to provide benefits and payments to employees after they retire. Isn't that a long-term liability? If I employ somebody and they're going to stay with me for probably about 20 years and I'm pushing money over into some account to pay them later, that's a long-term liability. That's why we identified defined benefit plans here. And that's going to be the end of Chapter 10.